Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we'll look at why Tesla is looking to hire nearly 800 new employees after its largest round of layoffs. Plus, we'll discuss why United Airlines gave disappointing guidance for the third quarter. But first, we look at quarterly earnings from the world's largest money manager, BlackRock. BlackRock hauled in $51 billion of client cash to its long-term investment funds in the second quarter. As a result, the firm hit a record of $10.6 trillion of assets. For more, we were joined by Neil Sipes, Bloomberg Intelligence Financials Analyst. We first asked Neil to comment on this week's news.
I think obviously over the past 18 months, banks have been much more in the focus. Asset managers, maybe a little bit of a sleepier name, so to speak. But like you said, BlackRock eclipsing $10.5 trillion. Of course, a lot of that is due to markets. We're up 15, 20% year to date. But BlackRock, sort of that perennial grower in the industry where organic growth, those flows from institutional retail clients have been harder to come by. BlackRock, having that breadth and diversity of the platform, has really been able to deliver growth through varying market cycles. We think that's one of their strengths and why they're the leader in the space in terms of size. In terms of the second quarter, organic growth a little bit lighter than expected. Part of that due to the fact that we saw some larger institutional clients sort of rebalancing portfolios. That's just sort of natural in the business, especially when you're at all-time highs. Nonetheless, margin really improved. Again, that's on the heels of stronger markets. Most of the revenue here is asset-based fees. So as markets move higher, the top line expands as well. And so really, you highlighted the last thing, I guess, ETFs, another strong suit that's really the bread and butter of BlackRock. Again, and obviously now with some of that private markets push that we've seen in the past couple months.
When do they hit the law of large numbers thing?
Yeah, I think that is becoming the more popular question for BlackRock.
But I could ask this question forever, right? And they still do it.
Yeah, and they continue to target this 5% organic base fee growth figure. They've been lagging that over the past couple of quarters. Obviously, markets, since the beginning of 2022 were less conducive. They've been more conducive for the past 3 quarters or so. But the question still remains, how do you continue to grow at that 5% clip when you're talking about a $10 trillion asset base? And we think BlackRock's diversity, when assets are in motion, they can continue to garner share from less diversified, less price competitors.
Stock hasn't done anything this year, kind of up 1% just on the year, lagging the market. What's the investment call here on BlackRock? What are the investors saying?
Yeah, so I think, a lot of what's been baked into this year is sort of market growth, which is going to be a benefit to all asset managers in the space. So I think the skepticism of, are these gains lasting? What happens obviously in November when we get this eventual Fed pivot to cuts? How is that going to impact client allocations? How is that going to impact the business model? But we do think BlackRock is is positioned to benefit in pretty much all market cycles, and a lot of that long-term story is now shifting into that private markets focus with Preqin acquisition just announced a couple of weeks ago and Global Infrastructure Partners in January.
Can I ask a really dumb question? At this point, who are BlackRock's actual competitors? Like, who can actually compete with this company?
Yeah, so there are plenty of competitors. I mean, asset management can be somewhat commoditized in a lot of spaces. Mm-hmm. There's competitors like a Vanguard. There's competitors like a Schwab, Invesco, Franklin, T. Rowe Price. There's plenty of names out there. The question is who's able to compete on price with BlackRock, and that's where scale really becomes paramount here, because they can continue to innovate with new products. If a new competitor comes out with, a new flashy product, BlackRock tends to match that and can sometimes beat it on price. And we know that BlackRock is entrenched with pretty much every institutional client, every retail client, so to speak, and that really gives them the strength of distribution to kind of leverage across its platform.
Our thanks to Neil Sipes, Bloomberg Intelligence Financials Analyst. We now look at this week's Bloomberg Businessweek cover story about former President Donald Trump. It's titled Trump on Taxes, Tariffs, Jerome Powell, and More. For the story, Businessweek recently sat down with the ex-president at Mar-a-Lago for an exclusive interview. They discussed Trump's plans for the U.S. economy and the world if he were to be reelected as president. For more on all of this, we are joined by Bloomberg Businessweek editor Brad Stone. We first asked Brad just how hard it was to gather details for this story.
Well, I mean, look, he wanted to talk. We'd actually put queries out to both campaigns. We heard first from former President Trump. You know, this is Business Week, so our mandate is business, obviously, economics, the world order. And we went there to interrogate him about an economic plan that many economists think is a bit contradictory. I mean, President Trump talks about lowering inflation. The agenda is higher tariffs, less immigration, which potentially raises wages. He talks a lot about lowering interest rates and then bringing members of the business community into his administration. So this is a topic he wanted to talk about. To put it in context, we talked to him 2 days before the first presidential debate and about 2 weeks before the assassination attempt. But even then, I think, he is riding what he believes, at least, and his campaign believes, is a heightened sense of momentum.
So, Brad, there's a lot of areas here in terms of economics to explore. Talk about taxes. How does he feel about taxes these days? He certainly had some big tax legislation in his first term.
That's right. And one part of his plan is to extend the Trump tax cuts. Another part, which he told us, was to lower the corporate tax rate. He told the Business Roundtable that he wanted to bring it down to 20% from 21%, if for no other reason that he likes large numbers. But then he said he would even get it down to 15% if he could. The challenge here, of course, is they don't delineate any way to pay for this, to make the numbers parcel out and do anything other than raise the federal deficit. And there is really, I think, a paucity of specifics here, which is one reason why proxies have kind of tried to fill the void with things like Project 2025, which then Trump really distanced himself from. But, I think, with the broad brushstrokes we got is Trump wants to lower taxes and extend his tax cuts.
What I also felt was very interesting is the myriad of views in relation to the tech industry. So on the one hand, okay, lower taxes, yay, tech industry. He seems to embrace crypto. Clearly, with J.D. Vance, there's sort of an embrace of VCs, but big tech is very complicated. How did you parse through that?
There's some contradictions here, Alex. I mean, the first is he's obviously very pro-American business, and yet he's turned on TikTok and believes that banning TikTok would only empower Mark Zuckerberg and Facebook. The second thing is, in the first term, he talked a lot about cryptocurrency and how it might engender fraud. He wasn't wrong about that, obviously, but now he's flipped on that as well. The bottom line here, and the way I interpret it, is that for Trump, it's all about personal relationships. And he went and talked a lot about Tim Cook and how smart he thought Tim Cook was, in large part because Tim Cook went to the White House to ask for relief from the first set of tariffs. He likes it when people come and, pay their respects or at least visibly look to be on what he considers to be Team Trump. And so, in terms of crypto, and a lot of people in that community are now pro-Trump. And, in terms of TikTok, where he's very popular on TikTok, and of course, Jeff Yass, one of the backers of ByteDance, is a Trump supporter, you can kind of see why these contradictions are sort of bundled into his views on technology.
Tariffs. Certainly, it seems to be the topic. We've had both sides of the aisle talking about tariffs and tough tariff talk. Mr. Trump used tariffs quite liberally. How's he thinking about tariffs these days? It's
interesting, Paul. I have not spent much time thinking about President William McKinley, the 25th president. He was from my former state of Ohio, and Trump brought him up repeatedly because, here's this 19th century president who, before the age of a federal income tax, was raising tariffs and bringing in money. And he said that McKinley is overlooked. Who knows what book club he's part of, but clearly they've been reading histories. And he wants to raise tariffs. He thinks tariffs are underrated. He's talking about a 10% across the board tariff. He's talking about raising the tariff on Chinese goods to 60% or even 100%. And, he says they're a great negotiating ploy. He tried that in the first term. And obviously then, a lot of U.S. companies, particularly tech companies, complained, and they were quite generous in their carve-outs. But this is a big part of Trumponomics, and most economists think that companies don't pay those tariffs. They turn around and pass them to customers in the form of higher prices. So there, we pressed them on it, and I think there are some unresolved contradictions and tensions there.
What's also interesting, I was reading a JP Morgan note about commodities and what the Trump administration would do to commodities. Obviously, that's my beat. But what they made the point is it really depends on the sequencing. So if you go to corporate taxes first, tariffs come later. Like the sequencing of how all of this works will really depend then on what the market reaction is. Did you get any sense of that?
No, in terms of how we would do it, I didn't. But
Yeah.
I mean, one thing that impressed us or was impressed upon us is that in 2016, he was unprepared to win. And he surrounded himself with people maybe a bit impulsively. And he says that he would do it differently this time, that he knows who's loyal and who's not. And he's experienced and he knows everybody this time. And it just seemed to us, that he is prepared to move quickly. In what order, I don't know. But particularly if he controls both houses in Congress, that they have an agenda that they're pretty much willing to implement at blitzkrieg speed.
Jamie Dimon as Secretary of Treasury, 30 seconds, Brad.
Yeah. What did he call him? An overrated globalist once. Look, he's courting the business community. Who knows if Dimon would do that, particularly considering how former members of Trump's administration often ended up being treated somewhat badly or breaking with him. But yeah, I mean, I think Trump wants to go and it's very important to him that business leaders like him. I mean, that comes through in the interview. And so he's doing his bit to court them as well.
Our thanks to Bloomberg Businessweek Editor Brad Stone. Coming up, we'll take a deep dive into how various industries would be impacted by a Donald Trump or Joe Biden presidency in November. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to politics. The direction of government policy in the world's largest economy is at stake when the U.S. elects a president in November. Bloomberg Intelligence took a deep dive into how various industries would be impacted with either Joe Biden or Donald Trump in office. For more on this research, we were joined by Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. We first asked Nathan to break down his findings.
What we did is we started with the report by looking at what are the key sectors to watch, and we really had 5 of them. The first one was investment banks. If President Biden wins, you could see somewhere between 7 to 10% increase in capital requirements. If President Trump wins, that could be off the table. We looked at electric vehicles. The tax credits for the electric vehicles could be at risk during our tax reform debate next year. Like you mentioned in terms of tax, global manufacturers. President Trump has called for a 15% corporate tax rate. Representative Steve Scalise said he's going to make the tax cuts for individuals permanent. So tax reform and the impact on manufacturing. And the other 2 were healthcare to the $25 billion subsidies. That's really for Centene and United Health. And then finally was big tech, because whether you get President Biden or President Trump, more likely than not, you're going to get a very skeptical Washington towards big tech, certainly both in Congress and also in the enforcement side.
Nathan, the question then becomes, what can he, and this has been the question throughout his 4 years also, what can he do on his own, and what would he need a Republican Congress for?
Yeah, so, I think one of the biggest questions we get from clients is, what does the executive order landscape look like if President Trump wins? And I'd say about 90% of the time, an executive order is a fancy way of the president picking up the phone and saying to his staff, I expect you to do X, Y, and Z. But there's a difference there. The difference is for trade, tariffs, and foreign relations, the power of the presidency is a lot more powerful when it comes to that. So when President Trump uses words like nasty, calling the European Union, that's something that investors have to pay attention to. Now, when it comes to tariffs, the president can certainly go out there and say, I want to do this, but then it's going to be up for Congress and the business community and so forth, but potentially try and influence the White House to either get to the appropriate amount or try in some cases stop it from even happening.
So are there certain industries that, I think about the healthcare industry. I'm trying to think about regulated industries, and healthcare is certainly one of them. And you mentioned the subsidies, but do the Republicans and the Democrats think differently about the economics of healthcare?
Yeah, it does. And this is really where the process comes into play, because that subsidies, that $25 billion subsidies, is Obamacare subsidies, and that requires an act of Congress. And I think you don't need to be a Washington expert to know that gridlock is going to continue no matter who wins the presidency. So look for subdued actions from Congress when it comes to healthcare. Now, the difference is on the regulatory side. On the regulatory side, and this is where you look at the FDA and a lot of the actions they've been doing, you can bypass Democratic opposition and just implement your own policies, but it takes time. And so I would say just general rule of thumb for a lot of the healthcare issues that are going on at the agencies after President Trump, if he wins, were to input his new regulatory leadership, at that point, you probably have another 18-month to 24-month window for any regulatory change. So for the healthcare industry, there's a lot of time to prepare for any changes. You'll know exactly what's going to happen well before it does.
Going back to the EV point, it definitely feels like solar, EVs, stuff like hydrogen from the IRA, like those are the stuff maybe potentially on the chopping block, potentially, with a President Trump win. But then the Musk thing is weird, because Elon Musk has definitely become a big supporter of President Trump, donating to super PACs, and I'm wondering if that relationship will change the calculus to how President Trump sees electric vehicles.
Absolutely. You hit it right on the head. And we even say this in the report. There's a difference between headline risk and reality. So if you look at the electric vehicles, you can look at statements that President Trump and other Republicans have said, saying they do not like these electric vehicle tax credits out there and so forth. But then you balance it with Elon Musk, and even taking it to a grander scale on the Inflation Reduction Act, a lot of the benefits of the IRA are going to GOP-led states. So what you have to do here is, A, take the statement, okay, if President Trump says, I want to do away with the electric vehicle tax credit, how am I going to do that? Most likely, I'll do that as part of tax reform and via the reconciliation process, which means I probably won't have any Democrats going aboard with me, so I need all Republicans on board. At that point, if Elon Musk starts whispering, saying, hey, we like these tax credits for the EV world, then that change may not even be a high priority anymore. So I would just say that for a lot of the statements, you have to remember short-term risk versus long-term risk. And as we see with every single election, politicians of both parties love to go out there and say, I'm going to do X, Y, and Z. But then when they get into power, it's X, Y, Z minus a whole bunch of other stuff because I'm going to be a little bit more moderate now.
Hey, Nathan, how about for our good friends on Wall Street, M&A bankers and lawyers? Under this administration, the regulator has been pretty tough, and it's been pretty tough to get big M&A deals approved. Presumably, that would be more Wall Street friendly, M&A friendly with a Republican administration?
It really depends on the leadership that President Trump, again, if he were to win, would put in place at the FTC and the DOJ. Because you have one side, you have the Republican business-friendly view, the stereotypical Republican business-friendly view. If you get somebody like Jamie Dimon, and I'm just picking on the banking execs, if you get somebody from Wall Street, like a Gary Cohn individual that was in his last administration, then you could just reasonably say that M&A activity will get a little bit easier. But if you get somebody that comes from the economic populist side of the party, for example, Senator Vance, the vice presidential candidate, spoke in favor of the FDIC chairwoman Lyman Khan and said that she was one of Biden's best picks. And so if President Trump comes out and picks an economic populist for the heads of the FTC and the DOJ, M&A may be very difficult for the next few years. It really just depends who's going to get that nod, and that would come right after inauguration if President Trump wins.
Our thanks to Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. We move next to the EV space and Tesla. This week, we heard the EV maker is looking to hire nearly 800 new employees. This comes nearly 3 months after CEO Elon Musk ordered the largest round of layoffs in the company's history. For more on this and the state of the EV industry, we were joined by Craig Trudell, Bloomberg Global Autos Editor. We first asked for more context on this week's news.
This is very Elon Muskian of Tesla in that it's sort of, it depends on the day what's going on at this company. So, yes, a few months back on the heels of Tesla selling about 20% fewer cars than it did in the fourth quarter, Elon Musk wasn't particularly happy with that quarterly showing. He wanted the company to cut headcount by a commensurate amount, so roughly 20%. So, for context, this is a company that, had quite a few employees at that time. They started the year with around 140,000, so that would mean 28,000 people being let go. It's unclear whether they got to that, but it is absolutely clear that, certain parts of the company were decimated. I think most notably the supercharging team. That really turned a lot of heads because it was a aspect of this company that has been looked at as such a sort of feather in their cap, that they really invested where others didn't and built a charging that worked, whereas others have not worked very well, particularly in the U.S. And so it is kind of shocking to see such a significant culling of people, followed by a hiring spree of sorts.
So do we know kind of what type of roles they're hiring for? Are they hiring people to bend metal, or are they looking to like some software guys for AI and all that, the robotaxi and
or
all
the
that stuff?
superpower people,
Yes.
the superheroes?
Yeah, I think we did report even weeks back that some of the supercharger people who were a part of the team that was really cut to a very significant degree were brought back relatively quickly. Notably, the woman who was running that group has not been brought back. And there were some reports that maybe she kind of tried to protect her team and was dismissed as a result of that. So in terms of what parts of the company are hiring, it's pretty broad, but I would say the data that our very own Kara Carlson has crunched, service is a big aspect, which is maybe no surprise in that the summer season is a busy one for Tesla. People are out driving for vacations. It's warm out, so they're running their air conditioners. To the extent that you do need to service an electric vehicle, that's one of the things that is common. So one of the interesting aspects of this story is that we did speak with people who were a part of this job cutting, who said that they were surprised that some of the service and salespeople, that the company, clearly needs at a time of, busy service work, and a company that's struggling to sell more cars. We're seeing some people being brought back there, but it is very widespread. I think notably as well, AI and robotics is definitely an area where everybody's looking at very closely because of what this sort of new priority is or emphasis is on the part of Musk.
Craig, GM's Mary Barra says the automaker won't sell 1 million EVs next year. So just another story, another data point about kind of maybe where the ultimate demand or lack of demand may be for EVs. What's the latest feeling within the industry about how this thing's going to evolve and what pace?
We've seen a really dramatic pullback on the part of GM and Ford in particular. I feel like, Stellantis, formerly Fiat Chrysler, they were sort of slow in the first place, making this transition, and have not necessarily had much to pull back from. But I would not be surprised if they sort of, joined the quote unquote party in terms of maybe dialing back sort of the ramp at which they tried to produce more electric vehicles and sell them. But it is very interesting to see, GM and Ford, really be sort of welcomed with open arms by the White House. Mary Barra being lauded by Biden as leading the EV transition. That really ticked off Elon Musk and helps explain why, in the last few days we've learned that he's been planning to spend quite a bit of money on, contributing to PACs to get Donald Trump reelected.
That was my thing, is that the Musk-Trump love affair I find to be quite interesting, because if we can just game out that the love affair is also so President Trump would be more nice to EVs, is the huge change that we're expecting with alternative energy and the IRA in a Trump administration maybe not going to happen?
Yeah, it is surprising. I mean, maybe if you're trading Tesla, you sort of reckon that the CEO very publicly endearing himself to the candidate will sort of, come back to benefit him down the line. And maybe some of these threats to do away with electric vehicle tax credits and so forth will fall by the wayside. Elon even went so far, to sort of claim that, doing away with subsidies would only help Tesla. I don't know how exactly he squares that circle, but perhaps it's a matter of Tesla is the strongest of the companies that's trying to make this work and is furthest along, and so taking subsidies away would hurt competitors even more so than it would Tesla. But it certainly wouldn't be good for Tesla to lose access to $7,500 for a lot of its customers in the U.S. or would-be customers. And right. So I do think it's very interesting, and we've heard very similar sort of anti-EV rhetoric on the part of J.D. Vance, his running mate. And so I think it's not only Trump who's sort of campaigned against EVs, but his running mate.
Our thanks to Craig Trudell, Bloomberg Global Autos Editor. Coming up on the program, we'll break down a slew of bank earnings in the U.S. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move now to U.S. bank earnings. This week, we got quarterly results from Morgan Stanley, Bank of America, and Goldman Sachs. And all three firms posted double-digit increases in investment banking revenue. For more, we were joined by Alison Williams, Bloomberg Intelligence Senior Analyst, Global Banks and Asset Managers. We first asked Alison what the street liked about Morgan Stanley's quarterly results.
Really strong institutional numbers. I mean, it was a great quarter for trading and investment banking. So equities trading really, I think, a source of strength. Morgan Stanley doing better than expected across the board. So equities trading, I think, was the standout. Fixed income, was sort of mixed, but really compared to a year ago, I think that's strong. Those revenues are turning out to be resilient. And on the investment banking side, investors are excited that there could be momentum coming into the next quarter. M&A still just historically low, so improving from a low base. Same thing with equities. But I think reasons for optimism, especially with the stocks in general doing so well.
Now, for Bank of America, when I think of Bank of America, I think of their corporate bank, making big loans to big corporate customers around the world. What did you see there?
So, I think the demand for loans is still something that we're looking more for the second half. If we do get the Fed rate cuts, that is definitely going to be a help. And I think for Bank of America, what people are excited about is that it could be the trough. So Bank of America saying that it's going to be the trough. This will be the weakest quarter, but keep in mind that they are baking in the Fed rate cut expectations and some loan growth in the second half. So we'll see if they can deliver that, but definitely telling investors what they want to hear in terms of the fourth quarter. A little bit higher entry rate, firming that up, and again that the most of the weakness could be behind us.
So does that mean that if we don't get Fed cuts, that Bank of America is going to have some problems here?
I think where the disappointment will come will be loan growth spurred by Fed cuts, right? Mm-hmm. So I think that some of the loan growth that they're factoring in is based on that. We heard from Wells Fargo where they're, still a lot more cautious on the loan growth side. And commercial and industrial has been a weak spot. Credit card has been the strong spot.
When I was in banking, one of our most lucrative businesses at the Chase Manhattan Bank was just leverage lending. Lending to companies that don't have assets or inventory or any of that kind. We just lend against cash flow. It's a little bit more risky. It's tough to show your credit officer where the collateral is for this loan. But we made a lot of money doing it. How's the private credit market been poaching on that business?
So actually, you would have been this would have been a good quarter for you.
I know.
You'd be happy. First quarter was good. Second quarter was good. And I think that if you look at some of the most recent statistics that we've seen is that banks are still doing a lot of that refinancing, right? So a lot of the business that's been happening in the debt markets, debt fees, a source of strength across the banks this quarter, has been refinancing, and that leveraged lending business has been doing well at the bank. So even though private credit is certainly raising a lot of funds and a product in demand, banks are still getting their share of refinancing in the leverage loan volumes. And that's, you saw like the huge growth at Citigroup and the numbers at Goldman Sachs where they have relative strength in those businesses. High yield's another area that's doing really well.
Back to the consumer. So we'll have Paul do the investment banking stuff. I'll do the consumer stuff. What about charge-offs on their credit card losses for Bank of America? Was that higher, lower? Where did that come in line?
In general, I would say their provisions overall came in line.
Okay.
We did see, charge-offs in the card business, charge-offs in commercial real estate. So those are areas that we're watching, but, controlled and in line with expectations. I think the area of weakness that we saw in card this quarter was at Citigroup. They have a private label label business that tends to skew on the lower income side of things. You're seeing losses come in above their targeted range. There is seasonal pattern to that, and so there are expectations that that could come in. But I would say the second quarter did not give us confidence in those expectations. So I think that continues to be an area for watching. It's not necessarily a big area for the big banks that we're talking about and the ones that I cover. But I think it's important to watch, for the overall economy and just to some of the other card names such as Synchrony.
CEO at Morgan Stanley. We have a new CEO, Ted Pick. I guess with a little bit of hindsight here, does it seem like it's kind of working and everybody's kind of found their place? And
so it seems like, he's talking with conviction. I think the boldest statement he made was with regard to the margins in the wealth business. So the wealth business, as you know, under the former CEO and a lot of acquisitions, wealth and asset management is the predominant revenue and profit engine. It's what investors are watching. The wealth margin was something where Pick early in the year took off some of the upside under the prior targets. Mm-hmm. And that 30% wealth target, I think, is a question among investors if they can get there. And Ted really trying to instill confidence that he is a believer. The wealth flows at Morgan Stanley, I would say, that is probably the number one thing I think that we watch for them. And that did come in weak this quarter. The fee-based part of those flows were relatively resilient, so some puts and takes there. But I think the wealth flows do bear watching, and that really has been the engine of optimism. Investors like the tilt towards the recurring fee-based business, and so I think that they'll have to continue to deliver on that 30% margin that Pick is confident in.
And then I'll go to sort of what the macro read is from Morgan Stanley, because also on the call, Ted Pick said that you're going to see normal M&A return unless there's a full-blown recession, and he thinks we're in the early stages of multi-year investment banking-led cycle. Oh, yeah?
Oh, yeah. But we've been hearing that for so many quarters now, and you're starting to definitely, feel more of the doubt coming from analysts, right? Okay. So the 2021, amazing. 2022, disaster. The lift that we got last year did not materialize. I would say that so far this year, M&A has been disappointing again. And, you can see in terms of the reported fees and the announcements, right? So both of those have been disappointing. It does tend to pick up late in the year. It does tend to pick up after elections. So I think it'll be hard to get, for that particular business line, sort of the momentum people are looking for, perhaps until after the election. But on the underwriting side, I think is where you're seeing, perhaps more of the momentum and strength. Goldman Sachs, though, who tends to be the biggest in reported revenue, did say significant uptick in their pipeline. Debt underwriting and advisory were the areas of strength.
Our thanks to Alison Williams, Bloomberg Intelligence Senior Analyst, Global Banks and Asset Managers. We move next to the airline space. This week, United Airlines reported second quarter profit that grew thanks to strong travel demand. But the airline also said third quarter profit will fall short of Wall Street's expectations. United warned that price cuts by low-cost carriers are weighing on the entire airline industry. For more, guest host Matt Miller and I were joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. We first asked George for his take on this week's results.
The industry is just suffering from overcapacity, right? United confirmed that. Delta told us the same thing earlier. We saw Alaska results come out. Their load factors down, yields flat, load factors down, telling me they can't fill airplanes at the right price point. We need capacity to come out. Everybody's pointing to an inflection point in 3Q. United said that they'd get down to maybe after mid-August, maybe 2-3% growth in capacity. I think that's just still a too high level of capacity growth, right? This is in an economy that probably year over year grew about 1%. I think that number ought to be tied much closer to GDP growth. You talked about unemployment rising, right? So the U.S. economy appears to be slowing a bit. So I think those things are working against the airlines right now. A bunch of capacity has to come out, I think, to get back to pricing power, and that's what's needed to get profitability going.
So how does that happen? I mean, do the airlines themselves pull capacity out? Don't they have competition in this market? Don't we have regulators to ensure that?
Yeah, so how does it happen? We're starting to see some of it happen. Alaska announced that they were going to add more premium seating to their
Can I just pause here for a fun fact,
Sure.
George? For a long time, Paul Sweeney thought that the Eskimo on the Alaska Airlines tail was actually a picture of Jerry Garcia.
I did.
Yeah, no, actually, he's told me that. And
I love it.
I'm not sure what that says about Paul Sweeney.
Exactly.
I mean, what an airline to put a picture of Jerry Garcia on the tail.
They're so cool.
All right, so sorry, go ahead.
So we're starting to see capacity come out with these announcements like Alaska, where they said, we're going to add more premium seating, which usually means a bit less capacity in the marketplace. Frontier's going to block your middle seat so you can get a premium seat out of Frontier. That obviously brings some capacity out. What you really need is you need airlines to start parking airplanes. And I think that's hard too, right? So United, Delta, all jazzed up about this inflection point. But look, I would note that there's a lot of very fast-growing, low-cost airlines in the U.S., Frontier, Spirit, even JetBlue, right? They lease a lot of airplanes. You fly airplanes you lease because you got to pay that lease payment no matter what, right? So I think it gets difficult here, and it takes a little while to get capacity out. Maybe next summer, I don't know.
I was talking with the CEO of JSX. They fly fascinating routes. For example, they'll fly from the Westchester Airport to the Naples Airport.
Right.
Or some airport outside of LA into Palm Beach. So are we going to see more of these upstarts, George?
Well, so we always do in the industry, right? So the beautiful thing about this industry is when people sell airplanes, someone buys them cheap and starts flying routes like that. And there's always someone that wants to come to this industry, right? It's got just a heavy allure. Everybody wants to own an airline. That becomes one of the challenges too, I think, in sort of making money in this industry. But the big folks, they'd love to have more maybe the ultra low cost point at those smaller airports, but you just don't get the demand out of those smaller airports, to really fill big airplanes. And so that becomes part of the challenge. I think right now, one of the bigger parts of the challenge is definitely business is we heard United say 100% of what it was in 2019. Obviously that gives you sort of no growth since the pandemic. They're saying the share of revenue in the cabin is lower. That's always at a really nice price point, and business likes to go different places than leisure does, so it diversifies your routes to a certain degree, but you need enough of it to go to those other destinations. So business just isn't back enough, I think, to let the big full service carriers move into maybe some smaller size airplanes, more diversified destinations, and get competition off those sort of heavy volume routes. And I think that's part of the problem too.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.